Practical accounting, the better way to learn.
Let's talk about cost accounting. Take it away, Dr. Hillard.
Now, let's move on to the next section. Let's talk about cost accounting. We're going to do an overview of terminology, tie it to the value chain, flow of costs, and share with you a unique base method, which is designed to help you understand what you're doing. First, what is cost accounting? Cost accounting gathers information to calculate the total cost and the average cost per unit produced and sold. While it's commonly applied to manufacturing organizations, it also applies to service organizations, any kind of operations, including like hospitals, not-for-profit organizations, et cetera, et cetera. But we're going to today be doing my favorite subject, all about pizza. We're making frozen pizza today. We have suppliers who supply cheese, sauce, boxes, freight in, et cetera, et cetera, et cetera. Remember, freight in is the service of having these other physical goods delivered. So these, when they are purchased from a supplier, they go into a warehouse, and we're going to call this our raw materials. Our raw materials are things we use to make our product. Then we move them from the raw materials warehouse to our factory. And every business has a factory. A restaurant's factory is the kitchen. Partially assembled frozen pizzas are called work in process. This is the second new type of inventory. We have raw materials. Work in process is just like what it sounds. It's work on that is in the process of being completed. Everything inside the factory, when the frozen pizzas are all done, we're going to move them to the third type of inventory. This would be now frozen boxed pizzas. We're going to call that finished goods. When the finished goods are sold, the cost that has been accumulated along the line will become an expense. Typically, the largest expense category for most organizations called cost of goods sold. Revenue, which is based on price. When the customer buys them, the revenue which is based on price minus the cost equals gross profit. Gross profit is the profit we make on the stuff we sell. Here's some key definitions. Inventory is something you purchase. It's an asset with the intent, or you can be making it, which is what we'll be focusing on in this chapter, with the intent to sell it. You're not going to keep it and use it. A cost is anything that is consumed to purchase an asset or an expense. So these are all considered costs. Over here, it's an inventory is a cost. Three types of inventory. Cost of goods sold is an expense. The price, which is the amount of revenue, is different than the cost. Remember, we're working from the inside now. The price is revenue, which is typically a credit and is a good thing because this is bringing funds into our organizations. The three types of inventory are work in process, okay, raw materials, which are items purchased, work in process, and finished goods. The definitions are right here. Cost of goods sold is when it becomes an expense, and gross profit is revenue minus expense.
Here's a great tip. Search how it's made and any product name, and you will get a free factory tour on how that product is produced. Check it out. Back to you, Jeff.
Take a look at the process of making a product or service. We have an important concept here. It's called the supply chain. The supply chain is the linked suppliers, also known as vendors, that produce things, and this could be first level, second level suppliers, sub suppliers, et cetera, et cetera. But ultimately, a supplier sends a purchase invoice and an invoice sometimes for freight in to the manufacturing, actually raw materials part of the business. Now, every business has another important concept here, a value chain inside the business. It's typically broken into these functions: research, which is pure and not product related; design, which is more specific to the product. As it moves through the chain, we're adding value. Then we actually make it in manufacturing inside the factory. These are what's known as product costs, which are an asset. Then we have marketing, which is advertising, selling, and other support costs, and distribution, which is shipping out and freight out. And once it goes to the customer, if the customer comes back for customer service after support sales. The key point here is that all of these outside the factory, everything outside the factory is an immediate expense. Repeat, everything except for what's inside your factory. So always identify your factory. You take it immediately as a period cost or as an expense in the current period as soon as it's incurred or spent, basically. So, manufacturing inside the factory, let's take a closer look at this. This is where cost accounting really does their thing. These are known as product costs. We're building inventories. There are three items that we use to make inventory. Direct materials are raw materials that are used and can be specifically traced and identified with a specific product. So if we're selling something for $100 on the right, and we have $30 of direct materials, then we also take wages, which are expensed only when they're sold. They're accumulated in part as part of inventory. Okay, so this is something that's very different. Workers' wages are now going to be inventory and then expensed only when sold. And then we have a issue here with manufacturing overhead. These are costs inside the factory that cannot be directly traced. Some examples of these. This is also known as manufacturing overhead, factory overhead, indirect materials, and indirect labor. Hey, folks, it's all the same stuff. This thing is, it's a shared cost, can't be identified with one product or one batch of products. Examples of this might be like building maintenance and things like that, supervisor salary, et cetera, et cetera. So let's take a quick look at how an income statement might look. We have revenue of $100, 30, 25, and 5 for direct materials, direct labor, and manufacturing overhead. We have cost of goods sold. We have a gross profit of 40, but then we have these period costs, which come in as operating expenses on our income statement before we make a profit of 15 on this sale.
In our next session, we'll introduce a new concept called the base method. And remember, you can get these files in Excel by going to practicalaccounting.com. See you soon.
Get this full video and the Excel workbook for free for a limited time only at practicalaccounting.com.